Okay. As I told you, we weren't allowing students to bring cheat sheets before, so this is an improvement already. So one cheat sheet should be more than enough. Okay. Today I'm going to start risk and return, which is not in the exam, which means you will probably not listen to the class at all. But this is a very, very important topic. And of course, it will be in the final exam for sure. So when I say risk and return, we talk about the basic idea behind it before. So we said the higher the risk, the more return you would require from an investment. Otherwise, you wouldn't take high risk, because people in general don't like risk. And today, we will talk about what is risk, what is return, the intuition behind those, and also how to find them mathematically. And in the second chapter of risk and return, we will talk about different asset pricing models, focusing on capital asset pricing model. And when I say model, I feel like I'm losing you, but this model is used by CEOs and practitioners all the time. So this is not a model that would be in the drawer and nobody would use. No, these are really important topics. Okay, so when we think about us, we make decisions every day based on different inputs, and based on our expected returns and based on the risk perceptions, we make some decisions. So probably today, you thought about whether you should attend to the class or not. And then you said, OK, what is the return? What is the return if I don't attend to the class? I'm going to have 1 hour of leisure time. Or I can use that 1 or 2 hours doing something else. But what the risk is, one is the FSAT grade. Missing the class would give you the risk of getting an FSAT. Or you may miss an important topic for the final exam. So you thought about it probably before coming here. And then you said, OK, if I don't go to the class, what I can do? I can go shopping. I can go, I don't know, play golf, play whatever, football, whatever. You thought about all those things. So these kind of decisions we make all the time. And also, these kind of decisions we make in the finance, in finance and investment part all the time. And of course, since we are not all alike, we have different expected returns, and we have different risks whenever we think about something. OK. So the thing we're going to do is, the focus is that. So we know that resources are finite. Because of that, we have to make good decisions. And we also know that we are expecting some kind of return from each investment. And this return is important. We talked about those things before. So we talk about what is your minimum acceptable rate of return. Do you remember that? We said, if you're going to make an investment, what is going to be your minimum acceptable rate of return? We can also call it as hurdle rate. Okay? So there is this hurdle that this investment should jump above so that you can take this investment. And this hurdle rate is determined by 2 things. One is, you should ask yourself, what would my return be if I don't take any risk? So how do we measure this? What is your return if you don't take any risk? How can you find this in the economy? What is the riskless rate in the economy? Is there a riskless, risk-free rate in the economy? We can take treasury bills as risk-free assets, right? We talked about this before. We said government papers are the safest ones, especially the short-term ones are the safest ones. Why? Because do you remember what was the big risk about bonds, about debt? bankruptcy risk or credit risk is an important item. And we know that governments going bankrupt probability is lower than corporations going bankrupt. So we said government bonds have the lowest risk. What was the other risk? Do you remember the other risk? Interest rate risk was another risk. And interest rate risk was lower for short-term or long-term bonds? Short-term bonds, perfect. So for the risky rate, we can use treasury bills, which are short-term government papers. So it's going to be your minimum acceptable rate of return whenever you're thinking about an investment. And on top of it, since your investment is riskier in nature, you would require a risk premium. So you're going to say, OK, if I buy a T-bill, I'm going to make 3% this year. I know that. It is riskier rate. But instead, I'm buying this corporation's stock, which is riskier. Stocks are riskier than bonds in general anyway. So for the compensation, you would ask the risk premium from that investment. So together, they're going to determine your minimum acceptable rate of return, which is the hurdle rate. So of course, the next question will be, how do we measure risk? How do we measure return? But before that, I think one important item is different people have different risk perceptions. Not everyone sees risk in the same way. So let me ask you this question, and I want all of you to answer, OK? So here is the thing. Suppose that I am offering you a game, and I say, I'm gonna flip a coin. If it is heads, you're gonna win $10,000. If it is tails, you're gonna lose $10,000. OK? So you're gonna give me $10,000. If it's tails, I'm gonna give you $10,000 if it's heads. Is it a fair game? What is the probability of having a head? 50%. What about the tail? 50%. So what is your expected return in this game? Can you calculate your expected return? It is 0, right? You will either win $10,000 or lose $10,000 with equal probability. So it's a fair game. So my question is, would you take this gamble? OK. Everybody has to answer. Who would take this gamble? Who would take the gamble? You would take it. Anyone? Anyone else? There's no right or wrong answer. It's just your preference, risk preference. You're not going to be wrong, OK? It's your risk preference. You would take it? OK. Who else? You would take? Sorry? No, one time. One shot. Who was that? Was it Marilyn Monroe who said, I wouldn't even leave my bed for what was that? OK. Who was, I don't remember. One of the models. OK. OK. So you're not taking the game. How much money would you require for heads to take the game? How big a win would you require from heads to take the gamble? So $10,000 is not enough for you. How much money would you require? So who would take this gamble if I'm offering you $15,000? Who would take it if I offer $20,000? $30,000? Who would take the game if I offer you $5,000? Very good, thank you. How about the rest of the class? I can't make any comments on the video about it. He has a point. OK, thank you for having absolutely no idea whatsoever. You should have this stand in life in every area as possible, so nobody would take you seriously. Very good. So basically, this is a fair game. For a couple of you, you said, I would take the game in those conditions. These people are risk-neutral people. Okay, it's a fair game. Risk doesn't mean anything to them. Some people, you said, I would take it even if I offer $5,000 to you. He's a risk seeker. He requires less return for more risk, which is actually not that unusual, but there are people like this. So thank you for answering this way. And other people who would require more than $10,000, these are risk-averse people. For more risk, they require more return. And the higher the money you want the win to be, the more risk-averse you are. So in general, in finance, in academia, we take people as risk-averse because we think that for more risk, people should require more return. But there are risk-neutral people who are indifferent about risk. There are risk seekers who just like risk. They don't care about return that much. So they just like the thrill of the risk. So there are different people with different perceptions. So even when I give you expected returns and risk, not everyone will react the same way. And it is because of their perceptions of risk and perception of returns as well. So what is risk in general is risk is about uncertainty. And it's all about variability of outcomes. What are the outliers? If you have lots of outliers in the outcome, it means that, this investment is riskier. What is return? Return will be your reward for taking that risk. Okay. I really like this. I found it in the slides of an NYU professor. And risk in traditional terms is viewed as negative, right? When I say risk, it is something bad. And if you look at the dictionary meaning, it says exposing to danger or hazard, which is also bad. But if you look at the Chinese symbols for risk, you know, in Chinese, all symbols can mean different things. When they, even the same symbols, when they come together, they might mean different things. So the description of risk is this. Is there anyone who knows Chinese in this class? Probably in 10 years, I will have some students who can speak Chinese in class. Okay, it's getting very common. So the first symbol is the symbol for danger, just like the dictionary meaning of risk. The second symbol is for the opportunity, which is actually the risk and return idea we're just talking about. It. More risk brings you more opportunity. So if you take risky investments, you can lose big, but you can also win big. So when there's risk, there's opportunity. You cannot have one without the other. So this is risk, and we're going to talk about how to measure risk in a second. But let's remember what return was. This is something we already know. Hopefully, you already know this. So what was return? We talk about it. The rate of return is basically how much income you generate compared to how much investment you made. And we can put it in two parts. You have the capital gain, and you have the dividend payments when we're talking about stocks, right? So normally we wrote it as like this. We said rate of return, or we can call it as holding period return. So we wrote it as dividend payments plus P1 minus P0 over P0. Assuming that we're buying it at time 0 and we're selling it at time 1. Okay, if you sell it at time 2, you'll make this time 2, and you put the other dividend as well. So you have something like this, and you can write it as dividend over price plus P1 minus P0 over P0. So this part is called what? Bakalım çalıştınız mı? Hayır ya. What was this part? Dividend over price. Dividend yield. What was this part? Thank you. Capital gain or capital loss. So if you sell it at a price higher than the original price, then you have a capital gain. If you sell it at a lower price compared to the price you paid for the investment, you're going to have a capital loss, gain or loss. So let's look at this example. The stock price for stock A was 75.06 per share 1 year ago. So it's P0. The stock is currently trading at 93.29 per share. Okay. Which is P1. And shareholders just received 137 dividend. What return was earned over the past year? So you bought the stock at 75.06, right? The price is now 93.29. Okay, and the dividend payment is 137. So 137 over 75.06 will be the dividend yield, which is equal to, let's go, okay. So this part is 1.8%. You get 137 compared to 75.06. What was the equivalent term in the bonds for this? What was coupon payment over price? Do you remember it? Coupon over price? Current yield, right? So, since stocks have dividends, we have the dividend yield. The other one, I don't know why they don't call it coupon yield, but it's called current yield in bonds. And this part is your, do we have a capital gain or capital loss? You have a capital gain because you can sell it at a higher price than the price you paid for it. And the capital gain yield is 24.3%. So this is a new chapter, but this is an old topic, right? We did this before. Dividend yield and capital gain part. So this is how return is calculated. Another thing that is important about returns is nominal and real returns. We also talked about those before. Let's see it one more time. So you probably remember this from previous lectures. 1 plus the real return should be equal to 1 plus nominal return over 1 plus the inflation rate. So in this question, your return was equal to 26.1%. And if you take inflation, this was nominal return. If there is the inflation of 4.1%, what is your real return? Approximately 4.1% inflation. This is the nominal return. Approximately. Sorry. 22%. How do you calculate real return? Nominal minus the inflation. This is the nominal return, 26.1. Deduct 4.1. So the real return should be around 22%. What is the real return? What does it give to you? So real return is about the purchasing power, right? So your nominal return was 26.1%, but at the same time, all the prices in the economy increased by 4.1%, which ate away from your real return. So your real return is reduced to 21%. Okay, so this is another important thing about returns. Now let's look at the historical values for risk and return. In the last part, we're going to talk about the statistical ways of measuring risk and return. So when I say market indices, remember we're comparing our returns with some index, with some benchmark all the time. In market efficiency, we talk about mutual funds, and we said to have an idea whether the mutual fund did well or not, we're comparing it with the market index at least to see whether the mutual fund brought you abnormal returns higher than the market index. And when I say market index, we generally use S&P 500 firms. These are the 500 biggest firms in the New York Stock Exchange. So basically, market index is a portfolio. You're putting a share from each company, each S&P 500 company in your portfolio. But the holdings are are calculated in proportion to the value of the stock. So what it means is, if you have two companies, one is 500 times bigger than the other one, then it's almost like you're putting 500 shares from the small company and 1 share from the big company in the portfolio. So the value that you are taking the value-weighted average of the stocks in the S&P 500. In Dow Jones Index, you probably heard about it. These are the 30 large industrial firms in US. And this is a little bit different than S&P 500 because they don't do a value-weighted average. This time they're literally taking one stock from each of those 30 firms and put it in portfolio. And the value of your portfolio is the Dow Index. Mesela Türkiye'de de biz BIST'te ne görüyoruz? BIST 30 var, BIST 100 var. En büyük 30 firmaya mı bakıyorsun, en büyük 100 firmaya mı bakıyorsun? Ona göre bir market index yaratılıyor. But as I told you earlier, we generally use S&P 500 as the market index. And this makes more sense because in this one, big firms are, you're basically, it's almost like comparing apples and oranges, like you're putting it in the same value. Here, you're putting the stocks in proportion to the bigness of the size of the company. This actually makes more sense. Okay, so let's look at what would you have if your grandfather put $1 in 3 different investments in 1900s. So that $1, if you put it in the stock market, it would be $21,000. If you put the money on the bonds would bring $191. If your grandfather put $1 in the treasury bills, it would bring $74. So which one is the riskier, you think? Which investment is the riskiest one? Equities. And so the expected returns from equities were higher. And in reality, this is also what happened. So in reality, in real return, equities brought more money to your grandfather. The safest one is the treasury bills. They brought only $74. They're the least risky ones, less money. And treasury bonds are longer-term government papers. They brought like 3 times more than what T-bills brought. And here we are using 3-month bills as the T-bills and 10 years bonds as the T-bonds. So let's look at the same thing on the table, and we're going to see we're going to start seeing important things here. So these are the average rate of returns for those 3 different investments from 1900s to 2010. So what is the average return in the US economy for 110 years? When you look at stocks, it's 11.4%. When you look at treasury bills, it's 4%. It's average annual return. For treasury bonds, it's 5.2. So the difference between T-bills and treasury bonds is called maturity premium. The only thing, like, since they have the same bankruptcy risk, what determines their risk is the interest rate risk, basically. And long-term ones, since they have high maturity, we call the difference between these two as maturity premium. And when you look at when you think about common stocks, or when you think about the returns in common stocks, let's go back to our previous slides. Remember, we talk about hurdle rate, which is your minimum acceptable rate of return. And for this hurdle rate, you're looking at 2 things. One is the risk-free rate in the economy. The other one is the risk premium. So basically, together, they're going to give you the reward for waiting and not consuming today, which is the return on the risk-free rate. And the other one will give you the reward for bearing the extra risk. So this part will be given by the risk premium. So in this table, what is the riskless rate you would use? 4%, right? You would use the 4% T-bill. So what is the risk premium? What is the risk premium? Can it be 0? We are talking about common stocks. So you want more return on top of the risk-free rate. So risk-free rate is 4%. What is the average return for stocks? What is the average return for stocks? What is the difference between these two numbers? 7.4, right? So risk premium is 7.4%. Let's talk about it one more time. So when you're investing in the stock market, your minimum acceptable rate of return, or your rate of return, is 11.4%. In this 11.4%, there are two things. One, what would my return be if I put my money in a risk-free investment, which is T-bills, and it's going to be your reward for not consuming your money today, but waiting, which is 4%. And on top of it, you're investing in common stock, which is a riskier investment compared to treasury bills. So you want you want more return to bear that risk. And it's going to be called risk premium. And the risk premium in the market, I should have it somewhere here. Okay. First thing to see is this message thing. This is the stock. This is the comparison of stock market and treasury bills from 1927 to 2008. So this smooth line is the return on the treasury bills, and this ultra volatile line is for the stock market. And as you can see, stock market is riskier than treasury bills. So every year, your minimum requirement is the T-bill. This is the minimum you would take if you didn't take any, if you didn't want to have any risk whatsoever. And on top of it, you're requiring some risk premium. As you can see, it's not necessarily the case that you're making 11% all the time. The average is 11%. In some years, in crisis times, the stock market crashes. So you want the reward for extra risk, but you're not getting it. So expected returns can be very different than your real returns. Realized returns might be different. But in general, we say, another graph showing the same thing. These are for the risk-free rate and for the market. So the risk premium for investing in the stock market was around 7.4% in the last 100 years. And this is the premium necessary to bear the extra risk. This is your expected premium. Of course, in the crisis times, you expect the risk premium, but you may not get it. But in normal times, this is 7% is what you should get on top of your risk-free rate, at least in the US economy. This is the value of $1 investment in 1927 and how it moves with the market. So here, you cannot see it, but here you have a blue line actually, which is the value of $1 if you invested in the risk-free rate treasury bills. This is the value of $1 if you invested in the market, in the market. And of course, the market brings you more money in general, except of course, you have a huge dip in the crisis times. So what is the takeaway from all these things is stock returns are highly volatile. If you don't want to take any risk, go with the treasury bills, but treasury bills will bring you very small return. If you are risk averse, very risk averse, go with the treasury bills. But if you are more risk seeker, let's say, then you can take more risk. And in that case, on top of the risk-free rate, you want the risk premium. You expect the risk premium, which is around 7% in the US market. In reality, you may not get it, but it's your expectation. Biliyorum hep aynı şeyi tekrarlıyorum ama bu gerçekten önemli. Hep ne diyoruz? Yüksek risk, yüksek getiri diyoruz. Ve hep öyle olacakmış gibi insan düşünüyor. Öyle bir şey yok. Risk almadığınız zaman gidersiniz bir devlet bono alırsınız kısa dönemli. Onun sana getirisi belli, risk yok. Ama eğer sen o paranı oraya koymak yerine hisse senedi alıyorsan daha fazla risk alıyorsun. Daha fazla risk aldığın için de daha fazla getiri bekliyorsun. Beklentinle gerçek olan farklı olabilir. Bazı yıllar kriz zamanları risk premium negatife düşebilir bir anda. O da gerçekleşebilir. Realized return is different than your expected return. But high risk means high expected return. And in reality, if you take the average, this is indeed the case. High risk investments brought more returns compared to less risk investments. Warren Buffett'ın galiba bir lafı var. You wouldn't lose money in the long run in the stock market der. In the long run, you don't lose money from the stock markets because in the long run, you take the averages. So for this 110-year investment, you made 11% per year. It's a long run investment, right? 110-year investment. If you look at the short terms, if you look at those times, these are here you had a minus 40% return in the stock market per year. Here you have like 25%, 40% losses in the stock market. But on average, if you take the averages, in general, common stocks bring more return. Biliyorum hep aynı şeyi söylüyorum ama bazen o gözünüzden kaçıyor gibi geliyor bana. But that's important. Okay, now in the last 5 minutes of this class, I'm going to ask you one thing, and then we're going to take a break. So first, I'm going to show you how to measure risk, and we're going to go into statistics a little bit. Let's remember what variance was. Variance is basically a measure of volatility, and high volatility should mean more risk, right? If you have a very volatile return, that investment is riskier. And variance is the average value of squared deviations from mean. And standard deviation is the square root of the variance, and it's also a measure of volatility. So here, in this class, to measure risk, when we talk about riskiness of assets, riskiness of stocks, we're going to calculate their standard deviation, return standard deviation. Let's look at this one. You have two stocks, and these are the return distributions. You have stock A. These are the possible returns, and these are the probability of returns. So this is how the curve for A lies on the graph. And this is another investment, B. These are the possible returns for B, and these are the probabilities, different probabilities of B. So which one would you prefer?
Where is zero?
Huh?
Where is the zero return?
What do you mean zero return?
There are possible returns, right?
Yes.
Where is the zero return rate?
I didn't actually. Does it make a difference? Let's say there's no zero returns. It doesn't make. You can put it here if you want. It doesn't matter. Okay, who prefers A? Elleri görelim. Who prefers B? Ah, more reaction this time, thank God. Okay. So let me go with this. Which one is riskier? A or B? Let's go back to the definition of risk. Yes. Risk. Variability of outcomes is the definition of risk. The more variability you have of outcomes, the riskier it is. So now let's go back to our A and B graph. Do you remember which one has more variability? A or B? B, right? The possible returns for A is from here to here. For B, on the other hand, it's from here to here. So B is riskier, right? So which one offers more return? What is the expected returns for A and B? B is riskier. Onu herkes gördü mü? B riskli. Çünkü daha fazla outcome olabiliyor. Daha büyük bir range var. B riskli. hangisinin expected return'ü daha yüksek? So these are nicely shaped curves. If you calculate expected returns, how do you calculate expected return? Probabilities times returns, basically. The expected returns would be just the middle of those curves. So as you can see, this is the expected return for A. This is the expected return for B. So B's expected return is higher. So B is high risk, high return investment. A is low risk, low return investment in terms of expectations. So there was no right or wrong answer. So if you prefer more risk, you can go with B. If you prefer less risk, you can go with A. Yes?
Can we make more observations out of this graphic? Like when we said it's riskier, can we say that its maturity the period is longer?
What rate is longer?
Maturity period is longer.
No, you can take it like just two common stocks. They don't have any maturities. It's just possibilities. B's returns are changing more. There's more variance in the returns for B. For A, it's smoother. Let's look at this, for instance. So these are histograms of returns for, using real data for common stocks, for treasury bonds, and for treasury bills. This is exactly this, actually. So instead of a curve, I have the, what's called? Huh? Neydi? So instead of curves, I just have those sticks. That's it. So as you can see, these are the probability of outcomes, which is number of years, since these are historical returns. And these are the returns we see. For common stocks, the returns change from minus 45% to 55%. So there's more variability of returns. Like there were like 10 years with like 0 return. There were 10 years with like 15% return. So this is the distribution of returns for stocks. For treasury bonds, long-term government papers, these are the returns we saw. So basically it changed from minus 10% to 40%, whatever. And for treasury bills, the diagram is even skinnier, let's say. The curve is skinnier. So as you can see, common stocks, which we already know they should be riskier, they have more variability in the returns, in the historical values. T-bills, they're not that risky. The range of returns is smaller for treasury bills, which was exactly like this. So you can go with stocks or you can go with T-bills, depending on your risk and return preferences. Any questions here? Okay, then let's take a 10-minute break.